All right, so let's begin the show with today's Meet Your Fund Manager segment, where we will talk about arbitrage fund. What are arbitrage fund? When are they expected to perform better? What are the risk factors associated? And what investors should keep in mind while picking up an arbitrage fund for their portfolio? All of this and more to discuss with arbitrage fund manager. So today the focus is on Bandhan Arbitrage Fund, and with me is Nemish Sheth, Associate Vice President Equity, Bandhan AMC. Nemish, good evening and welcome to the show. We will definitely talk about the nitty-gritties of the fund and the way the portfolio has been designed. But then before that, let's just start with a very basic question. What are arbitrage funds and how do they work?
Sure. Thank you, Kavita, for having me on the show. While arbitrage are relatively a bit complex, I will try to explain it in a very short and a simple manner. Arbitrage funds are basically equity-oriented hybrid funds, wherein a fund manager engages in buying a particular security or stock in a cash market segment and simultaneously selling the same stock in a future or a derivative market segment at a premium. Now, this premium is also referred as spreads, eventually, which are the returns for an arbitrage fund. Let me illustrate this. A fund manager buys or engages buying a particular stock at 100 rupees in a cash market segment. Simultaneously, a fund manager will also sell the same stock in a future market at 101. Now, this spread of 1 rupee is a premium which an arbitrage fund manager will earn. Now, this 1 rupee is a premium also known as a spread, which are typically a return for an arbitrage fund. So this is what happens when a fund manager engages in a particular arbitrage activity.
Right, Nemish. So now looking at a particular fund, I would want to know what is the current portfolio structure and exposure in your fund, and how is the fund keeping up with the market volatility?
Sure. So as I had referred, it's an equity-oriented arbitrage fund. So predominantly, we have an exposure of around 65 to 75% in an equity and equity-related instruments, whereas the remaining 25 to 30% is into debt and money market instruments. So as it qualifies and it's an allocation of more than 65%, it also has a benefit of an equity taxation. Now, as we had positioned last month, we are around 72 to 70% equity allocation. Now, this is factoring how the markets are moving and what is the momentum of the market. What are the yields as compared to its relative peers category. So this is how we will try to, align and design our portfolio according to the market sentiments.
Got it. Talking about your sector exposure, could you elaborate on that?
So basically, because it's a properly hedged kind of a portfolio, we would have around 65 to 75% in a large cap category, whereas the 25 to 35% would be in the mid cap to small cap category. So this is how we structure the portfolio based on the large and the small cap sector analysis.
All right. Looking at the timing and looking at the volatility in the market, what is the current strategy that the fund is adopting in terms of, hedging and in terms of placing your bets?
Sure. So we have observed and our past data suggests us that whenever market is in an uptrend or the positive momentum of the market with an volatility, it has always favored the arbitrage category with respect to its relative peer category. Currently, as we have seen from last 3-6 months, we have seen that there has been positive momentum in the market. We have seen that this category has outperformed most of its relative peers. And this has been reflected in the performance of the fund in last 3-6 months. Also, what we have seen is in last couple of months, we have seen the category getting back the inflows which was expected and which has been underperformed from quite a while. We've seen around 10 to 15,000 crore back to the industry and the category. As a fund house, we are expecting that this momentum could continue going ahead, and we would continue to see the favor in the scheme going ahead. So we can expect 5 to 10,000 more crores back in the category where we had seen it last in March 2020. If we have analyzed this category, ideally gives a positive return and has never given a negative return if you hold it for 30 to 50 days. So being a properly hedged kind of a portfolio with an equity taxation, I think this is a well-placed category currently to play with the market.
Nemish, now keeping that in mind, I also want you to help us understand the kind of risk factor and a risk profile that one needs to have in order to have an arbitrage fund in their portfolio, and how, when we compare it, when we compare the returns to maybe any debt instrument, is there an upper hand in terms of returns as well?
Right. So basically, as this is properly hedged portfolio, we have to consider that there might be some few risks in the market. The risk kind of a market risk or a liquidity risk. A scenario where uneven event kind of an event happens in global geopolitical markets that can affect the returns of the portfolio. Irrespective to the category, we have seen that this category has given a better returns than the few of the debt category. So we currently are positioned that this kind of category would continue to give a better return than relative to its debt peers.
Talking about the inflow, how has been the inflow in Bandhan Arbitrage Fund? Couple of months inflow, if I just want to understand the trend.
So last couple of months, we have seen around 20 to 25% of inflows back to the category, and the same inflows we have seen in the Bandhan Arbitrage Fund. As I have mentioned, that we would continue to see such kind of an inflows in the category because of its performance and the yields inching up. We could see more inflows into such category.
Nemish, now, generally the price spread of equities in the cash market and the future market depends a lot, the trajectory of these funds to perform. So far, you think these spreads have improved in a couple of months? What would be the current status and how would you explain that?
So we have seen the spreads been improved post 2021. We have seen that when the interest rate scenario started picking up, we saw the yields were nagging behind the relative peer category. What has happened is as soon as the market sentiments improved and we see a lot of inflows into cash equity segment, what happens is a lot of positions on the future side also tends to roll over, and this has benefited the category in last 3-6 months. Also, the data suggests that this uptrend in the market and the sentiments in the market would continue. So hence we are pitching and we are recommending this category to invest for the investors.
Okay, more or less we can say that the returns are in line with the money market instruments.
It has been outperforming by 50 bips to the money market instruments. One is because we've seen the equity momentum in favor of the arbitrage category because of its tilt towards an equity instruments. Second is it has a clear benefit of having an equity taxation. So both of these have worked in favor of the category, and we continue to foresee that we can have this conditions going ahead the same.
How are you playing the debt part in the portfolio now, looking at the interest rate scenario, and what we also got to know from the Jackson Hole meeting also, and inflation is still a problem, monsoon is still a problem for us when we talk about domestic triggers. How is the debt play being played in the fund?
So, as I had mentioned, this is basically an equity and equity related instruments. So ideally 65 to 75% is an equity related instruments. The only part of 20-25% which we have in debt component is basically a margin and collateral given for taking a position on equity and equity related instruments. So besides that, 3 to 4% we would have high debt papers. Besides that, 1 2% we will have a cash. So debt is a component which we play for collateral and margins, and we buy a high quality debt papers like a treasury bills or government securities, which are well liquid in on any of the markets.
All right. So talking about this particular category, which is the category that would clash for an investor if they place it in their portfolio? What kind of an advantage first this kind of a fund can give to their portfolio in terms of diversification and in terms of a tactical play if at all they want one, and also which category to avoid if you already have an arbitrage category in your portfolio?
So it all depends on what is the scenario currently and what is the expectations of going ahead in the future. So currently, as a while back, debt was a favorite category, and interest rate scenario also was in positive momentum for a debt instrument. So we were of an opinion that the tenth of the money should go towards the debt instruments. As we have seen that the market sentiments have improved, we had suggested and we were recommending our investors and the distributors for going ahead with an arbitrage category based on the how the sentiments of the markets are, and this is how we would place going ahead also. Any situation comes, we would try to move from an arbitrage category where the yields are coming off. We would try to move on the ultra short term category or debt category.
All right, things to keep in mind when you want to opt for an arbitrage fund in a portfolio. What should be the key highlights or the key homework that an investor needs to do, Nemish?
So basically, whenever any of the investor who wants to invest in a category would have to take into consideration the market risk, the liquidity risk. Even if we say it's an perfectly hedged fund, it comes with the volatility, it comes with market risk. So we would suggest, we will always try to suggest to the investors that come to a category where you have an investment horizon of 6 months to 1 year. Also come with an horizon that this is a volatile market, so the returns will not be as what it has generated in the past. So come with an expectation that in a volatile markets we can have a volatile kind of a returns.
All right, Nemish, thank you so much for being on the show today, helping our viewers understand all the nitty-gritties of an arbitrage fund, and thank you so much for giving us all the details on Bandhan Arbitrage Fund.
Thank you. Thanks, Kavita. Thank you so much.
All right, so that was all about the Bandhan Arbitrage Fund, and we also help you understand this particular category for your portfolio and the diversification process. It's time for a quick break, but then before that, let me also give you our WhatsApp number and our email ID where we keep waiting for your portfolio related queries. All you have to do is just send us your queries, be it about mutual fund, insurance, tax, a loan, anything to do about your financial portfolio or your financial planning or your financial goals. Just WhatsApp your question to on 865-797-4571, or you can also email us your question on themoneyshow@etnow.tv. So that's the place where we keep waiting for your queries. A quick break, and post that, let's talk about your investment in gold. You're watching The Money Show with me, Kavita Thapliyal, and let's move on. We are talking about your portfolio, and in your portfolio, it's important for you to have different asset classes. And today, let's also focus on gold. What's the trajectory of gold going ahead after the concerns over inflation and interest rates? Should you be buying gold in your portfolio? Near-term outlook of gold and your strategy. Let's understand all of this. We have G Chandrashekhar, commodity expert, with us on the show today. Good evening and welcome to the Money Show, Chandrashekhar sir. All right, so let's just first give our viewers a backgrounder of what's happening with gold. You know, on the domestic front, we do have inflation, and we do have a scenario where we could see interest rate hikes. But then most importantly, what we heard with the Jackson Hole meeting, where Fed Chair person also said that they will not bow down from raising interest rates if that's a kind of scenario. Obviously, a lot depends on the data that might just come up in few months. But then what's happening with gold? And when we talk about the shine, do you think in the near term this will again go beyond 2000, or you think it's going to be range bound where it's a time for an investor to maybe strategize something for their portfolio?
Thank you, Kavita. Because India is not a price setter, but a mere price taker, it is important for investors here to understand the global scenario. Now, in the last 12 to 15 months, as we know, the US Federal Reserve hiked interest rates several times to contain inflation. Despite these successive hikes of interest rates in the United States, inflation is still well above 2% target. The labor market is still tight. It's quite robust. And more important, the private sector demand is rather resilient. And therefore, these have actually encouraged an uptrend in the US real yields, which continues to remain intact, maybe very small changes. The dollar continues to remain strong. The dollar index is slightly above 104 with a possibility of going to 105. And most important, the market participants are pricing in a soft landing of the US economy. Until 4 to 6 months ago, everybody talked about a big recession in the US. It is not coming anytime soon. There is the talk of a soft landing of the US economy. At the same time, look at the demand side. Look at Europe. Europe is slowing substantially, recession in some of the pockets. China is slowing versus the 5.5% GDP growth rate target. China will probably be growing at about 4%. India is no better. Inflation is quite high, unaffordably high for many of the poor people, and it's actually hurting and burning holes in the pockets of people. And that is why speculative investors have exited gold in some measure, and speculative net long positions on the bourses have actually fallen. And therefore, the current ecosystem for gold is far from supportive. Therefore, gold is under pressure, and therefore it is range bound. It is around $1,900 a troy ounce, give or take 1%, maybe 1880, 1920. It'll be in that range.
All right, but then we cannot complete this discussion without talking about inflation and the trajectory of inflation. Okay, talking about India, definitely monsoon is a dampener. The El Nino impact is activated. Okay, talking about US inflation, you know, despite of all the concerns and despite everything trying, it is not exactly at the level where it should have been. In fact, it going up looks much more likely. You know, the household savings have gone down. The credit card borrowing has gone up. So the situation is really not supporting what they were expecting by this time of the year. So let's just focus on the inflation part, and how much do you think the chances are more towards an interest rate hike in a couple of months, maybe in the next policy itself for India and US?
Yeah, absolutely. In fact, let us look at the Fed Chair speech last Friday at Jackson Hole. He has actually, if you've noticed, he's actually raised the bar for further rate hikes. He has not ruled out further rate hikes. He simply raised the bar. That is number one. For the Fed, in my view, will very closely watch growth, will watch labor market, and will watch inflation. And therefore, interest rates in the US, which is actually the driver of the world economy and the market, interest rates in the US will stay higher for longer. That's the expression they are using. There is one meeting in September. I give it a reasonably small probability of a rate hike in September. There is another meeting in November. The November meeting, I'm sure, holds a slightly higher level of probability for a rate hike. And once that November rate hike happens, I expect a long pause for at least 6 months, possibly going up to April 2024. And any talk of a rate cut, we are talking about rate hike. There will be talk of rate cut. that will not happen until the second quarter of next year, April, May, June, because all these monetary policy, the effect of the monetary policy will always have a lagged impact or a lagged effect. So these successive hikes in interest rate in the US will show themselves up in slowing economic growth, etc., after the first quarter of next year, when possibly the Fed can think of a rate cut. And therefore, when you look at all this big picture, on current reckoning, my view very clearly until the end of this year, I see gold continuing to remain under pressure. It will most likely trade in the $1875, $1925 an ounce in that range. And you talked about India, which is very important. We are arguably the world's large importers and consumers. And therefore, our rupee has faced headwinds. Our rupee has actually weakened, but thanks to RBI intervention, it has not weakened to the extent it ought to have under normal circumstances. And that is why my expectation is the rupee will probably trade between 82 and 83 and a half, or 82 and 84, thanks to RBI intervention. Now, we have to look at the demand side also, which is very, very important in my view. And a lot of people actually ignore the demand side. Physical demand is going to be weak. Physical demand is going to be enervated, whether it is India or China or even Europe to some extent. Physical demand is going to be weak, particularly in India, as you referred to the southwest monsoon. I think it's been suboptimal so far, and therefore inflation is unlikely to decline in a hurry. Rural income growth, in my view, is going to be weak and tepid, and that is going to create demand concerns for gold. And for this is a big picture. And for within this, I think our viewers will need to think about how best to invest in gold and reap benefits. My view, and let me make it clear, I'm not a trader. I don't hold any trading position anywhere. I'm a student of this market, and I speak with a certain responsibility. Or I would think the investors should actually buy gold at every dip, but they must have the capacity and the intention to hold on to this position for at least 6 to 8 months, because only 6 months from now, there is a possibility of the gold prices rising towards $2,000 or even slightly go above $2,000. And therefore, buy at every dip is one suggestion, but you must have the clear intent to hold it for at least 6 months, if not more. Then, of course, one would certainly reap good benefits. On the other hand, I would think silver investment today is more likely to give better returns, because
gold
even
strategy
towards the end of the...
Yes, sir. So let's just get the gold strategy straight for the
Yeah.
investors once again. So you can
Yeah.
buy on dips, and the time horizon for that should be at least 6 to 8 months. You've got to be patient with the prices, okay? But then, let's continue talking about silver. Silver, you think is shining brighter than gold?
Yes, silver
Okay.
is certainly shining brighter than gold, as you rightly said, because silver is also an industrial metal. Okay, and therefore the world market is actually facing a deficit. That when you look at the supply-demand fundamentals of the silver market is actually in a state of deficit, and plus its industrial application. And that is going to lift, in my view, silver prices going towards the end of this year. I will not be surprised if silver touches first and then breaches $25 an ounce, and from the current levels of around 23 or whatever. Yeah, and therefore silver, in my view, has a much better potential for the next 4 months to give better returns to investors.
All right. Now, that being said, could you also talk about the right way to invest in gold right now? Are we talking about waiting for next tranche of sovereign gold bond, or you think buying an ETF or a gold fund makes sense? Because sovereign gold bond is a better deal, also because of the extra return that you get over the market price.
Yeah. No, I would actually pitch for sovereign gold bonds. One can actually, there are so many investment avenues available as far as gold is concerned. I think you need to put money in each one of them. For example, in the overseas market, in the US market, people are exiting ETF. That is again putting pressure on gold prices. But if someone has the intent, clear intent, and the capacity to wait for another 6 months, I think all those various avenues of investment one can look at, but gold bond scheme appears to my mind a much better option.
All right, so that's all about commodities and gold and silver as an asset class, if at all you want to add in your portfolio. Thank you so much, sir, for being on the show and helping our viewers with this today.
God bless.
On that note, let's take a quick break, and post that, let's talk about paying off your home loan. Now, someone who's aggressively looking at paying off their home loan, this is a good strategy for you. And also, definitely, people are really tensed about and worried about the raising EMI. But then how could you strategize paying all your home loan in one go, or maybe in lump sum? What should be the strategy behind it? And also, your portfolio-related questions. All of this getting answered after this break with Gautam Kalia.
Just another focus.
So with me, Kavita Thapliyal, and now we move on and let's talk about your home loan, and in fact all those people who really want to pay off their home loans as soon as possible. Is it the right strategy for you? Yes, you must be worried about your rising EMI, but then is this a good strategy to pay off your home loans in lump sum? Are you really financially ready for that? Should you be taking up this aggressive step? And if you can, what should be your financial portfolio status? Let's decode all of this with Gautam Kalia, Senior Vice President, Head Super Investor at Sharekhan by PNB Paribas. Gautam, good evening and welcome to the show. A very crucial topic, because a lot of time our viewers also keep asking us, the repayment strategy for their home loans. Definitely, rising EMI is a huge concern, which is burning a hole in their pocket. And although banks have tried increasing the tenure of the loan, or people who are preferring raising the EMI limit have gone ahead and done that also. But the interest rate scenario is still not very clear, looking at inflation and monsoon and different kind of concerns, even of the global market, Gautam. Now, keeping that in mind, if someone really wants to pay off their home loan in lump sum, or maybe aggressively just use up all of their investment, and if at all they have that much of money, do you think it's the right strategy to just get rid of the home loan, specifically looking at the interest rate scenario, which earlier this year we were talking about, we might see a rate cut happening by the end of this year, but that looks very unlikely looking at the kind of scenario. So what is your take?
Great question, and these questions come up a lot with our clients as well. Really, interest rates don't seem to be easing up, so your EMI may be here to stay for a little bit longer. Your inflated EMI, which has obviously gone up over the last 1 or 2 years. But really, when it comes down to what we are talking about, is a problem of plenty, where you are able to afford the higher EMI. And it's, let's say, coming at the cost of your SIP, your monthly payments to your investments, your monthly savings, or you're trying to decide whether you should redeem some of your investments in other asset classes and try to pay this off. So really, it boils down to opportunity cost and comparing the two. And the simplest way that I explain this to my clients is, when you're looking at a home loan, you're looking at an asset class where you're getting a guaranteed saving of 8.5% or 9%, depending on what rate you're paying. Let's assume, for the sake of simplicity, you're paying 8.5%. So it's like a guaranteed saving of 8.5% if you pay off more of your home loan. And if you start viewing it like that, it's like a fixed deposit where you're putting in money and you're getting 8.5. Here you are saving 8.5 by paying extra and paying in advance. So if you're able to flip that in your mind and think of the EMI like that, then you understand that this is like an investment at 8.5, and then you can compare with other investments. So if you have SIPs and equity mutual funds, that have delivered 18% CAGR over the last 5 years, then the comparison becomes between whether you want to continue earning that 15 to 18% CAGR, we normally project 12, or you want to have this, which is like a guaranteed, reduction. So really, it becomes a choice there, and it becomes a little bit more complicated when you add in the tax element. So depending on whether you've taken a joint loan and it's a joint ownership or it's single, how much tax are you really saving? Because that is also a guaranteed amount. So my suggestion to everyone would be that if possible, if you are bullish on equity and you have equity investments, and therefore let's say the next 10-15 years, please continue with those and continue with your EMI. There is no hurry to close your loan. You can continue with both because we've done the calculation. Really, it works out best over the long term, even if you assume a 12% return in equity versus let's say 8.5% home loan rate, because really that's the math. So math will always favor the higher return. But obviously keep in mind your tax saving and try to make sure that you are able to maximize your tax saving as well when you're deciding to, let's say, part prepay. But if you're more conservative and you say, 8.5 guaranteed return is much better than, let's say, market may not give me 12, market may go down. And if you have that kind of a view, you're not very comfortable, your risk appetite is not that aggressive, then you're better off, prepaying your loan as quickly as possible. Though in the longer term, if equity does deliver 12% plus, then you are at a loss. So that is something that you have to keep in mind, what you're most comfortable with.
All right, so you obviously have to look at your financial status and accordingly strategize this repayment strategy. But then having said that, the part payment process is very important. Do you think one can use their investments to do that as well?
Absolutely. So you can definitely, let's say if you have a SIP of 30,000 and suddenly your EMI has gone up, you can for a period of time reduce your SIP and fund your EMI. Or let's say you have a lump sum payout, you can redeem some of your investments and put that to reduce your outstanding home loan as well, so that you reach a comfortable EMI stage. It's all about your comfort, what you're trying to find in terms of balance. But you need to keep this in mind that every rupee, because it's all about opportunity cost. Every rupee that you take out from, let's say, an equity asset class where you're projecting a 12% return, and you are putting that in reducing your home loan exposure, where you are essentially, in a way saving 8.5% every time you put extra money. So that opportunity cost needs to be kept in mind for your own comfort. So if you are seeing that a large chunk of your salary is going in EMI and you're just not comfortable with that on a month-on-month basis, and you want that to be at a more controllable level, comfortable level, then definitely, you should do that, because money shouldn't be a source of stress. So you should do that to make it easier for you, because let's say tomorrow if the market corrects and you're looking at your portfolio going down, then you may be induced to taking wrong investor behavior because you have this big EMI also on your head that's going on. So it's kind of finding that balance between what you're comfortable with and really how you are experiencing this on a day-to-day basis compared to your salary. So my suggestion would be, yes, do seriously consider part prepaying your home loan, while evaluating your investment decisions.
All right, I have more questions on this topic, Gautam, but then we really have to move on and start taking viewer queries also because that's what people are really waiting for with you. I don't have Ramesh Morwal on the phone line, Gautam, but then I do have his question with me. So he wants to understand if investing in an ALSS fund for someone who's about to retire will be a good strategy or not.
So, Ramesh, you can continue with ELSS if you are paying tax, and it still serves as a tax saving vehicle for you post retirement as well. But if you're not paying tax and you don't need that additional tax saving, then you have other categories in mutual funds that you can consider, which achieve the same objective but don't come with the additional lock-in of a 3-year like a ELSS scheme does. So many ALSs follow a flexi cap strategy. So you can look at a flexi cap category fund or a multi cap fund instead of putting more money in ALSs than you need to. Unless there are some really good funds out there that beat and you're comfortable with putting in money locked in for 3-4 years, and you're not really you don't envisage needing that money, then it's okay. But otherwise, I would not suggest that you take that additional lock in for no reason.
All right, Gautam, we move on. Mr. C.K. Yadav is on the phone line with me. Hello, good evening, Mr. Yadav. How are you doing today?
Fine, madam.
Thank you so much for sending us your question. And you want to know best index funds for almost 5 to 7 years, and that's your time horizon, right?
Yes, madam. Yes, madam.
Perfect. And you want to invest via SIP into a mutual fund, and what will be your investable amount? Any goal attached to this investment?
Maybe 5,000 per month.
Okay. And for how many years? 5 to 7. Okay, perfect. Got it.
Yeah.
Gautam, over to you.
So, Mr. Yadav, I'll give you the index funds. My suggestion, because it's 5 to 7 years, we are suggesting equity index funds. So you can look at about 40% allocation to the HDFC index fund Nifty 50 plan, a 25% allocation to the ICICI Prudential Nifty Next 50 index fund. So these are large cap focused. Then the rest 35 allocation is to one mid cap and one small cap focus. One is the Motilal Oswal Nifty Mid Cap 150 Index Fund and the Nippon India Nifty Small Cap 250 Index Fund. Now, just in case, because your question was that you wanted index funds, just in case you're open to the idea of looking at actively managed funds as well, our research has selected 5 funds to share with you, which you could also consider because their performance has been quite good, and they are part of our approved list. One is ICICI Prudential Blue Chip Fund, where we suggest you look at a 30% allocation, again large cap. Tata Large and Mid Cap Fund, where it's a large and mid, their 10% allocation. Then 30% in mid and small, which is SBI Magnum Mid Cap Fund and ICICI Prudential Small Cap Fund. The last fund, where another 30%, which is a flexi cap, which is HDFC Flexi Cap Fund. So you could consider a more active fund portfolio as well to meet your needs.
Have more time in hand. Is Mr. C.K. Yadav online with me? Mr. Yadav, you want to ask any more questions to Gautam?
No, sir. No, madam. That is fine.
All the best. Prasanjit Basai is our other viewer, our next viewer who's on phone line with me. Hi, good evening, Mr. Basai. How are you doing? From where are you calling?
Good evening, ma'am. I am calling from Bhagalpur, West Bengal.
Okay. All right. So I can see the details that you've sent us.
Yes.
So you have invested, you have regular investments going on in share market and mutual funds also you are investing in. You have 6 mutual funds? Okay.
Yes, ma'am.
And you're investing since how many years, sir?
I am investing last 1 year. From
Last
end of
1 year.
I am started investing last year in June 2022.
Okay. All right. First of all, congratulations, Mr. Basai. You've given us your monthly take home and you are able to invest in direct equity. You are doing it through mutual funds also. Congratulations. And this is definitely a learning for the other viewers who just keep wondering how to save that little bit of penny, to start their investment process. So congratulations over there. But as far as your funds are concerned, are they good or not? And your time horizon is 10 to 15 years and you want it for your daughter's better future, her higher education and also your retirement. Retirement goal you might want to think about and give us an approximate figure in terms of corpus. But then for your daughter's education, 10 to 15 years, how much of amount are you looking at? What's the ballpark figure that you want to give?
After 15 years, I am expecting around 1.2 or 1.5 CR.
Okay, just for one goal or both the goals?
No, these goals may be only for my daughter education.
Daughter's
and
education. Got it.
As per little bit for my retirement concern.
Okay.
Also.
Got it, got it. You might have to increase your investment amount, but then let's get this direction right from Gautam. Gautam, although it's a very aggressive target that he set for himself, 1.2 crores for daughter's education, and we also know that one has to think about future and one has to consider inflation when we're talking about education, which really moves higher than the food and other kind of inflation that we talk about. Okay, 1.2 crores in 15 years, and so far investments in mutual funds is 6,000 rupees.
Great. So, Mr. Desai, again, congratulations on this journey. You're on the right path. I'll just come to your funds in a minute. But at the rate at which you're saving now, if your total investment of 12,000 per month grows at between 10 to 12% a year, you're looking at roughly about 24-25 lakhs in 10 years. And that 24-25 lakhs corpus becomes 50 lakhs if you extend it to 15 years. So just that additional 5 years will double your corpus to 15. And if you can just add another amount here gradually as you invest and just keep it held for longer term, like 15 years, then I'm sure you'll be able to reach your 1.2 crore that you've indicated. So just keep the journey and just try to save gradually more as you can. Now, when I come to your mutual fund schemes, HDFC large and mid cap, HDFC mid cap opportunities, and quant small cap fund, there's no need to change. Please continue. The Mire Asset Flexi Cap is a new scheme. So we won't be able to provide you a view right now because there's not enough track record for us to study it. But as of now, please continue with that. We'll be happy to give you an opinion after the year. Your HDFC FlexiCap fund also, please continue. There's nothing wrong there. And your Navi FlexiCap fund, it's a FlexiCap strategy. So maybe move that to an ICICI Prudential Blue Chip so that you have a large cap allocation as well, because you don't have any large cap in your portfolio. So that's it from an allocation perspective. Only one fund that you really need to change for now, and gradually over time, I think maybe as you build more savings, maybe look at other asset management companies also to add maybe 1 or 2 schemes in, because you've got already 3 schemes of HDFC.
All right, Mr. Bisai, is there anything else you want to ask Gautam?
Sir, just I have now around 42K salary of my monthly income, but gradually my salary also increased and my savings amount also increased. I can assume after 1 or 2 years my salary and promotion will be happen. So after 1 year or 2 years I can invest more and that could be increased up to 15K.
Sure. Yeah, sure. That's the right strategy that you should be opting, and that is also expected also from you, because the corpus that you want to reach, you will have to increase your investment amount. Thank you so much, Bisai, for sending us your question. And with that, thank you so much, Gautam, for being on the show and helping our viewers with their financial portfolio queries. And wrap up on the Money Show as well, but then I'm going to leave you with our WhatsApp number and email ID, where we keep waiting for your financial portfolio queries, be it mutual fund, insurance, tax, loan, anything you want our guidance about. 865-797-4571 is our WhatsApp number. The Money Show at etnow.tv. That's the email ID where you can send us your queries. Thank you so much for watching. Goodbye.